Moneyweb now. On the money.
This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. Chatting with Tasneem Samodien. She is research analyst at Private Clients by Old Mutual. Tasneem, appreciate the time today. Thinking about Richemont and going back a decade, and I remember this at the point, there was a fair bit of luxury pressure in the luxury goods market, fair bit of turn down in the market. Richemont at the time responded quite decisively. They bought inventory back from the sort of wholesalers and fundamentally changed their business model, going from wholesale to more direct to consumer. It wasn't an easy change, but it's really benefited them.
Thank you for having me. Yes, Simon, I'm giving away my age now, but I remember it like yesterday, ahead of the AGM around 2017, 2018, and Richemont put out the notice to say its operating profit was going to be down about 50%. And obviously there was a sell-off in the market and we were investors at the time. So it was a very painful period for them. And they could have waited, for the luxury market to turn because there was an overall slowdown. But I think management acted very decisively in saying, look, we know that there is a downturn, but we also see these gaps and the issues in our business. And we are actually going to take action. We're going to buy back watches from the grey market. We're going to take more control over distribution in order to take more control over pricing. And it cost them for 2 years, there was, this share price overhang as management was instituting these actions. And so it's so pleasing to see, 10 years later, that those changes that they made to the business is now placing them in such a strong position to outperform their peers and outperform the overall sector.
I'd forgotten about that collapse in the profits. I'd remembered the sort of luxury downturn. I'd forgotten just how bad it had got. I was also at that point in time a shareholder, and it was nasty on the share price. But it has worked. Direct to consumer is now, over 3/4 of group sales. A decade or so ago, it was around half. It was a big move. It's absolutely paid off just in terms of the numbers.
Yeah, I think we must also remember at the time, it's easy to say now that everyone's going direct to consumer. But back in the day, it was very traditional for luxury brands to focus on, brand equity, building the brand, and for wholesalers to distribute the luxury products. Mm-hmm. So that was very much the status quo. It was kind of going against the grain to say, we are going, as a luxury brand, we are actually going to go into retail. We're going to own our stores, put our own retail staff, build relationships with customers. That was going against the grain, building our own e-commerce platform. They kind of did what other peers weren't willing to do, and the peer group obviously certainly followed after that. But now they have much stronger relationships with their clients that is actually filtered into how they design their products. If you go on the online site now, you can actually influence the design of your Cartier Love bracelet, for example. So it's placed them in a much stronger retail position. Apart from, just taking control over distribution, there's been multiple ways that it's actually made them much stronger and improved their brand equity as a result. But now the business is, much more. Back in the day, it was 50-50 wholesale versus, direct to retail. And now it's predominantly direct to client.
And I get your point. It does. It gives them more control over that relationship. Aside from, pricing and inventories and all of that, it is that direct one-on-one relationship, which can go wrong. But in Richemont's case, it's really, really worked. We've also seen jewelry become more important than watches. Way back in the day, I remember with the first smartwatches and concerns around Richemont, because they were so reliant on watches, they have also leaned a lot more heavily into jewelry instead of the watch.
Yes, that's true. Like 10 years ago, Richemont was, the struggling luxury watch company. That was very much the narrative. But it's leaned, and obviously management paid attention to this commentary and the concerns of the investor base. So they've really leaned heavily into Cartier, into Van Cleef. They've bought more luxury brands along the way, driving that brand equity and also just better able to build a story, build a relationship with the customers around, when you buy your love bracelet, the Alhambra design that is very popular with a younger luxury consumer. So they have leaned into it, and it is a category are much more able to influence pricing, whereas specialist watches or luxury watches, then there's a lot of nuance that goes into how watches are priced versus how the jewelry category is priced. So I think it was absolutely the right action to increase the contribution from jewelry in their business and decrease the exposure to the overall luxury watch category.
And if we look across the sector, and there isn't sort of really one-for-one comparison, there are other luxuries, but LVMH has got everything from, fancy whiskies onwards. Richemont really stands on its own as sort of proper, pure luxury, and it's also made it a much more defensive luxury good company. Companies often pivot and make changes. This is almost an MBA study in it going incredibly well and benefiting shareholders and the company itself.
I mean, we must say that while there was clear management action, to tilt the portfolio in the direction of jewelry and take back the relationship with the customer, there's also a bit of luck in
Sure.
the jewelry category in particular is benefiting from this precious metal price tailwind.
Mm-hmm.
Richemont has not increased its prices significantly to compensate for what we've seen happen in the gold price and precious metals. So customers have this perception that they're not just buying a piece of jewelry, they are also buying an investment. The item that they purchased a year ago is worth more today just based on the gold content, on the precious metal content. And that is also supportive of demand. And we've seen that play into Richemont's rating.
I hadn't actually thought of that. Of course, just the good old-fashioned metal prices or precious metal prices helping significantly. Leave it there. Tasneem Samodien, research analyst, private clients by Old Mutual. Appreciate the time. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions.